Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. US stocks set for gains as investors look for trade optimism, and Japanese news flow drives global long-end bond yields lower. The UK market also reopens after a holiday. The EU agrees to fast-track trade talks with the United States, saying there's now a new impetus for the negotiations after President Trump delayed 50% tariffs on the bloc. Plus, Germany's Chancellor gives Ukraine permission to use weapons to strike deep inside Russia, bringing it into line with the US and the UK.
In the meantime, a quick check on these markets here. You are seeing a catch-up trade in the UK, but not so much in Europe. The FTSE 100 higher by 0.9%. Eurostoxx 50 futures, though, virtually unchanged. We'll see if that changes at the open. The story this morning, as Anna mentioned, is all about Japan. We are seeing dollar-yen at 143 handle. We're going to keep an eye on that long end, which is already having ripple effects globally. Take a look at the U.S. 30-year, 497, already down by about 7 basis points. The countdown to the opening trade starts right now.
Moments of change can also be moments of opportunity. The ongoing changes create the opening for a global euro moment. And this is a prime opportunity for Europe to take greater control of its own destiny.
Christine Lagarde, the president of the ECB, throwing her hat into the ring, and the ECB's with it, suggesting this could be the moment that the euro starts to shine finally after being created back in 2000. Is the exorbitant privilege that the dollar has enjoyed for generations starting to come under pressure, not only from the euro, but also from the Chinese currency and others as well? We can think of Bitcoin maybe into that ring as well. It is a key moment. We haven't seen many moments like this in history. Are we overdoing it? How serious is the threat to the buck right now?
Yeah, absolutely. Is this just a change, a shift in the balance at the margin, or is this something really fundamental in terms of the dollar and its role in the global economy? Christine Lagarde clearly pitching this as an opportunity. So one person's loss is somebody else's opportunity, and this could be an opportunity for the euro. She went back to the Nixon era, talking about coming off the gold standard and how at that time there wasn't any much alternative to the dollar. Is there really now any alternative to the dollar, or is this just, as I say, at the margins of de-dollarization? So that and what's happening at the long end of the Japanese curve really dominating market thinking as we go into Tuesday's session.
Christine Lagarde needs to talk to Jane Foley over at Rabobank, and I'm pretty sure she, a couple weeks ago, came around this table and said that the euro is only 25 years old and therefore cannot be the reserve currency of the world. So I'm curious to hear what Lagarde has to say to that. But that's just one piece of the equation. You have the entire Japanese bond market as well that's also being factored in to this dollar move. And I think that's really fascinating here, that although the euro is kind of enjoying this weakness that you're seeing in the dollar, it isn't just the U.S. that's factoring in here that are the cross currents. It's also a question out of Asia.
So here's an interesting. Dan Curtis and I, our producer, were kicking this around before we came on air. And there's an interesting way of looking at this Japanese story. So the Japanese are trying to manage the long end. They're worried about what is happening at their long end. You've got the Ministry of Finance basically coming to the market and saying, we're going to issue maybe front end rather than back end. We're going to change the issuance story. The market kind of breathes a huge sigh of relief. But what happens here is that the dollar bounces. And in some ways that's curious, because for quite some time the dollar has been the run home to mama trade. If everything goes wrong, that's where you go. And you do wonder whether that is changing, because this is a risk-on moment and the dollar is rallying in a risk-on moment. In some ways you could argue the other side of the dollar smile, but I think that's an interesting it's an interesting moment that all the other havens are selling off. So the euro's become a haven, the yen's become a haven, Swiss francs become a haven, gold's become a haven. They're all selling off. The dollar's going up at a time of risk on.
Yes, and we have definitely seen the dollar respond very differently to risk on, risk off in recent sessions, haven't we? And just to underscore the extent of the moves that we're seeing at the long end of the Japanese curve, we're down by 25 basis points on the 40-year, 21 basis points on the 30, 18. These are really, really big moves, and they are risk on, although I got some cautious words from Mark Cudmore earlier on the Markets Live blog saying they do just illustrate the vulnerability, though, don't they? The fact that we've gone so high so quickly in terms of the yields, and now just the Ministry of Finance consulting on issuance can have such an impact on yields. It does also underscore a vulnerability.
Absolutely. Some jitters in the market for sure. And that yield move, again, to your point, seeing the opposite reaction to the dollar. When you see yield moves to the downside like this, the dollar should not be bouncing, and yet here it is. I will also quickly make the call that the CFTC speculative trade last week actually showed people pulling away from their dollar shorts. They're still aggregately short on the dollar, but not as short as they were.
Can I throw something else into the mix as well?
Please.
President Trump is a huge crypto fan. And in some ways, you could argue that the President of the United States, by being a huge crypto fan, is undermining the dollar as well. The move you've seen recently into Bitcoin, you could argue, could be a haven story as well.
Yeah.
And his support for it, in some ways, argues against the dollar and its role as the kind of the global safe haven currency.
All part of his agenda to attract manufacturing back to the States. A weak dollar is going to be part of that recipe, which brings us to his trade agenda. It's been 5 minutes into the show and we haven't yet talked about a trade deal. I think it's time.
Put that right, Chrissy.
Exactly. I think that's interesting here because yesterday's story was all about what the EU and the U.S. were going to talk about in terms of a delay for July 9th. You're starting to see a catch-up here in the U.K. in terms of pricing that in. Now the EU planning to fast-track that message. We've heard a series of phone calls coming from the likes of Giorgia Meloni with Washington as well. In addition, Giorgia Meloni also consulting von der Leyen as well. We talked about pharmaceuticals, autos, etc., being the key underpinnings of that potential trade deal. I don't know if anything has changed in the story from there then, but you are seeing more voices now speaking up.
Are we going to see any change to these two geographies just talking past each other when it comes to trade? Because that seems to be what has meant that we've made this incredibly slow progress on this front. The Trump administration, the Europeans want to talk about zero for zero. So, you know, you take your tariffs on these industrials to zero, we will as well. But that's not where Trump is. Trump wants to talk about non-tariff barriers, and he wants to do that at the national level. And so these two geographies just talk past each other at the moment. Can they find common ground?
What is the shiny thing that the Europeans can use to attract Trump to allow him to say, I've got a deal, and therefore we can move on? A bit like we've seen with the Chinese. The Chinese are in for the long game. They're going to be talking about this for a long, long, long time. The Europeans kind of play the same game as well in some ways. We'll talk about this a little bit later with Diana Choleva. But you do wonder, what is the shiny thing that Trump can take that is enough of a win to claim that he has done what he has said he would do and move on?
Yes.
I don't know what it is, but I doubt it's pharmaceuticals. I doubt it's autos. I doubt it's zero tariffs on industrial goods.
Well, it was
There's
LNG
going to be something
for like
else.
a minute.
Yeah.
And that's faded.
And Europe offered on that front to buy more LNG. That didn't seem to get the traction.
Is it a massive weapons deal? Is it something like that that would allow him to say, we're balancing the scales?
Well, I know this takes us into our next topic of conversation. Is it something around taxation on big tech? Because we've seen big tech and the MAGA movement get incredibly close recently.
So I've got a series of topics which I'm calling buckets of money. Okay. Where are the buckets of money this morning? And there's a whole series of stories on the Bloomberg terminal this morning I think are fascinating. I've got to put my glasses on so I can read about all of them. The first one is this revenge tax story, which, to your point, is about value-added tax, which is basically a withholding tax. We've got this tax law that's going through. It's just come out of the House. It's going to the Senate. And there's a provision within it that talks about increasing the withholding tax of assets that are held passively in the United States that come from countries that have things like VAT. So you increase the cost of having European assets, global assets in the United States. So what do you do with those assets? Do you take those assets out? Is this a barrier to putting money to work in US asset markets? I think it probably is. So that's one story, the revenge tax story. Then you've got this PME story this morning on you've got this Dutch pension fund, which is basically saying all of these US asset managers that are managing money for us, that are acquiescing to Donald Trump on things like DNI and climate, we need to change our mandates. We're not going to go with you. We're going to change our mandates. We're going to go with other fund managers that don't acquiesce to the Trump administration on these issues. Again, money potentially coming out of the United States. And then I think you've just got this wider story, which is the credit story. Germany is now the biggest creditor in the world. It's overtaken Japan. Has this massive current account surplus that it's running with the United States. So again, it's just kind of, if money starts to come back, if we rebalance trade, money comes out of the United States. All of these stories, three stories, point to money coming out of the US, not into the US. And that's a huge shift from what has happened over the last 15 years.
Yeah, the Japan losing its top creditor status for the first time in 34 years, losing it to Germany. These are the countries vying for the opposite end of that spectrum to the conversation we're normally talking about, which is usually about trade deficits. Well, here we have the other side of that trade. We have where the surpluses sit, and which countries are coming out on top as a result of that.
But how do you? This is what Trump wants to fix. But in order to fix that, do you need to see money coming out of the States? Do you need to see a more balanced trade account, which leads you to a more balanced current account, which effectively means less money flowing into the dollar as assets, which takes us full circle back to where we started the conversation?
And all three players you mentioned are going to affect the long end of the curve, not the short end, which is just only intensifying and amplifying some of the moves that we're already seeing.
OK, let's talk about the guests we've got coming up. We've got some great guests lined up to talk about all of this. Florian Ielpo, Lombard Odier Investment Managers, Head of Macro, is going to be joining us in a moment. Diana Choi-Lever is going to be joining us from Inodo. We're going to talk China there. I'm hearing lots of people talking about Xi Jinping kind of drawing on Mao and what happened in the 60s, 50s and 60s. Nancy Curtin, Ulti Tiedemann, Global CIO, joining us on the other side of the pond. And Tom Keating, RUSI Centre for Finance and Security Director. Looking forward to that conversation, Kriti.
Absolutely. Plenty of data to keep us occupied, as well as we get perhaps some more direction from not only some of our guests, but some of the geopolitics and the monetary policy around the world as well. Some things to put on your radar here. At 1 p.m. UK time, we do have a Q&A with Ramaphosa out of South Africa as well, plus a Hungarian rate decision at 1 p.m. UK time. But I think the focus here is on the U.S. data, and that's going to be the U.S. durable goods at 1:30 p.m. UK time, as well as the U.S. consumer confidence, perhaps really gearing us up for that data dump on Friday, where I think we have PCE and UMISH data.
Yep, Friday's going to be an interesting little session. I think we're looking forward to that one. End of the week as well. Like it's only Tuesday. We only just started the week for most people. Here's what else you need to know this morning. 27 people have been hospitalised in Liverpool after a car ploughed into a crowd. The incident took place in the city centre. Thousands of people basically had gathered for Liverpool Football Club's Premier League victory parade. Police say a 53-year-old British man has been arrested. The German Chancellor, Friedrich Merz, says his country and other major allies are no longer imposing range restrictions on weapons supplied to Ukraine. It comes as Kyiv's Western allies attempt to intensify pressure on Russia. This after Russia launched its biggest drone barrage against Ukraine since the full-scale invasion over 3 years ago. And Bloomberg has learned that HSBC has cut more than 24 analysts in recent days as Europe's largest lender deepens a restructuring of its investment banking business. Sources say the cuts, mostly in Europe, include the departure of Stephen Major, global head of fixed income research. The restructuring aims to increase efficiency and is expected to lead to $1.8 billion in charges over the next 2 years. It is a bank like so many banks, and you can look at what is happening at Citi. At HSBC and Citi feel like they're going through the same kind of big shift at the moment. HSBC is doing similar things and making fairly big changes at its investment bank. Stephen's been on this programme many times. It's sad to see him go. I hope we see him again.
Sure we will in another capacity, but it speaks to this larger point that you made here, which is that maybe research, especially with the introduction of AI and other strategy, isn't the go-to mechanism anymore that it was, say, 10 years ago, Anna.
Coming up on the programme, we'll talk sanctions and how trade wars are playing into that narrative with Tom Keating from RUSI. Plus, we'll keep an eye on defence stocks at the open after NATO's Secretary-General confirms the alliance will seek to adopt a new spending target of 5% of GDP. Hardly any, well, a lot of countries, I should say, not getting to 2% just yet. Many will by this summer, but still, that is a more near-term focus. Up next, the ECB's President Christine Lagarde says it could be the euro's moment. We'll discuss that shortly. If you have any questions, if you want to get involved in any of these conversations around this desk, IB plus BBTV Go is the function to use. This is Bloomberg.
Moments of change can also be moments of opportunity. The ongoing changes create the opening for a global euro moment. And this is a prime opportunity for Europe to take greater control of its own destiny. But let's not fool ourselves. It is not a privilege that will be bestowed upon us. Today, I think there is a key difference compared with previous eras. With the euro as the world's second largest currency, there is another international currency alongside the dollar. Europe has many of the key ingredients for success, but they need to be brought together in order to reinforce the foundations. So action is in order.
Christine Lagarde sees an opportunity. The president of the ECB there speaking in Berlin. Now is the moment. This is the time for the euro to step into the spotlight. Florian Ielpo, head of macro at Lombard Odier, joining us around the table this morning. Is this the euro's moment?
It looks like it, at least, and somebody on the other side of the Atlantic is actually making sure that the European countries they stick together.
Yep.
We just got a slap on the wrist saying negotiation, we're going nowhere. And following that, the 50% tariff threat has actually put some order in the way Europe could be responding to the US. You see, I think Europe, you know that Europe grows basically from crisis to crisis.
Yep.
And it's just in of those crises that is helping the European construction going forward. Now, the euro itself is also profiting from that because globally of the sounder fiscal situation in Europe. So there are a lot of plus, I would say, when you contemplate the future of the euro.
What would be the advantage of Europe enjoying some of America's exorbitant privilege? Like, if it was, in all seriousness, and I know we're getting kind of a little maybe ahead of ourselves, but say there was some of that halo effect that we've seen having such a big effect on the US economy over the last few years. How transformational could that be for Europe, or are all the other impediments, bureaucracy, red tape, multiple countries, all those other things, do they offset any of that advantage that Europe may enjoy?
The best point of comparison is 05-07. I am a children of 05-07.
Okay. Younger than me.
My Netflix stocks is actually, let's say, some financials in Germany. Meaning, over that period of time, the euro was quite strong, and the reason for it is Europe was showing strong productivity gains, and with that was attracting capital from elsewhere, and this was creating some pressure on European corporates to perform. And that's pretty much what's been happening in the US over the past 5 to 10 years. Strong US dollar, strong productivity gains, and the huge impact in terms of US GDP, and GDP per capita has been rising like never, right? Now, the euro could be, Europe as a whole and the Eurozone itself could be enjoying this kind of situation. And we've got the plans, we've got the rearmed situation, we've got the euro gaining in traction because of a better fiscal position.
So it's interesting. So you could argue that Germany losing the Deutschmark, which was very strong, and forced Germany to be efficient, maybe we'll start to see some of that coming back in. The Swiss have had that problem and been forced to be efficient. I wonder.
So that's where the thinking goes. I mean, in terms of the short-term concern, though, Florian, for Europe, I suppose they need to craft some sort of response in terms of the trade conversation with the United States. Where can we move forward there? Because Europe keeps offering lower tariffs and the US keeps talking about taxation. The US doesn't like digital taxes, it doesn't like VAT. I mean, these are things that are outside the remit of any trade negotiator, usually. So how on earth can Europe and the United States make progress by the deadline?
It's very difficult to see. There have been discussions also on the position of the US dollar and trying to find a way to weaken the US dollar as a gift through those negotiations. Honestly, the trade deficit between Europe and the US is not that big. It's going to be very difficult, I think, to find genuinely effective elements. Now, you always have this old agrarian way of negotiating, like you take my corn and I'm going to take something from you. Now, there is still this layer of uncertainty. How will we strike any deal? And we haven't seen anything of the like. What's been happening in the UK is clearly not paving the way to creating a tick box, you see, of things that we need to go through so that you can reach a trade deal. So from that perspective, uncertainty remains quite high.
Yeah, a lot of uncertainty there. So we were worried about trade. We continue to be worried about trade. We add in that last week's concern about the long end of bond markets in the United States and in Japan. I mean, today in Japan, we see a real relief that the Ministry of Finance is consulting around issuance at various tenors, and as a result, long end yields are coming down. Are you comforted by long end yields coming down, Florian, or does that just underscore how nervous markets have become about long end borrowing?
Markets at the moment are very nervous about long yields. We have this screening of volatility that guides our investment multi-asset funds. And the largest increase in volatility we've had over the past 6 months was on the bond side. Duration at the moment is very risky. And in Japan, as in the US, when you compare it to cash rates, you're getting somewhat not well rewarded for the risk you're taking. There is also a lot of bearishness, especially in the US, on the back of, well, fiscal situation, trends, sentiment, and potentially retail investors not so much interested in holding bond at the moment. Now, the way we see it, it's very difficult for fiscal policy to tame the bond market. Monetary policy does it well, but fiscal doesn't. Like, it's very difficult for monetary policy to tame inflation, but fiscal do it quite easily. So this is a paradox, basically, and Scott Bessent, just like the Minister of Finance in Japan, will need to do their best, communicate as well as they can, so that you can tame and turn these higher rates into an opportunity. For the moment, the rising yields are creating more threat than opportunity, also pressuring equities in their wake, which is something that we need to look at. Every equity portfolio manager right now should look at their bonds colleague and have a chat with them.
Yeah. Good luck with that. I don't think they speak ever. But Florian, there's an old adage that says that if the U.S. sneezes, the rest of the world catches a cold. And I'm curious that if there is a recession coming down the pike, a self-imposed one, perhaps, from as a result of the tariffs and the trade deals and a slew of layoffs we haven't yet seen, can the rest of the world, all the fund flows that are going into Europe and arguably Asia as well, can that sustain in that scenario?
I make a difference between the bond situation and an equity situation. On the bond market, as soon as we see rates increasing in the US, well, it's driving the rest of the curve altogether because of arbitrage, the arbitrage situation. Now, on the equity side, it's a bit different. Like, what makes equity indices rise is earnings perspective. At the moment, earnings growth expected in Europe is 0 by the end of this year. So in terms of the upside risk there, it's quite significant if we're surprised positively by growth. If in the US, we see in the second part of the year something that will look like a recession. Of course, it will contaminate the rest of the world. Remember that recession in the US plus trade war is the perfect recipe of 1929, which helps recession spread out to every country on the world. And
it also came with a pretty big stock market crash.
I was about to say,
point that one
what
out.
happens to U.S. assets?
A 6-year one, yeah.
What happens to U.S. assets in that scenario?
Yeah. This scenario, from our perspective, is quite unlikely at the moment. And markets are very much focused, like we were discussing before the show, is very much focused on the current situation. And that current situation is really not too bad. US normalization, still some growth momentum in Europe. And that's the only hard data we have at the moment, and it's still surprisingly decent. So we are thinking, of course, of the next 6 months, but at the moment we think that nowcasting makes more sense than forecasting in terms of our investment policy, normalizing exposure, remaining neutral as possible, until the moment this uncertainty dissolves into either recession or just to slow down.
Well, when we have more clarity on that, we'll bring you back. Florian Ielpo, head of macro over at Lombard ODA, joining us around the table this morning. Coming up, we're going to start the conversation on what's going on in the Asian bond market and what the ripple effect is here into Europe and then ultimately into the United States. Japanese bonds rallying on optimism that the government is considering reducing their debt issuance. It gets a little wonky. We're going to dive into the details next. This is Bloomberg.
Welcome back. 30 minutes until the start of equity trading here in Europe. This is the picture for European equity market futures. Expect some divergence. The London market might go its own way. FTSE 100 futures expected to show the moves of yesterday, essentially, for the rest of Europe. The rest of Europe had yesterday to price in the pulling away from that 50% tariff, at least now, on Europe from the United States, and a little more time for talks between Europe and the United States. And, Guy, the increasing pace of that conversation. We're promised that there's some new urgency behind it. The other parts of Europe, though, we might see some more lacklustre performance. Yeah, the rest of Europe came up to where we started the Friday session. We've gone nowhere in between. London's playing catch-up to that. Let's talk about the bond market.
There is some interesting action, you could argue, at the 10-year tenor in Europe. As you can see, we're catching a bid this morning, unsurprising given what else is happening in Japan. The real action is further down the curve. So you get into the 20, 30, 40s, and that's where the real story is. So the Japanese bond market at the moment, and I'm looking at the 30-year, is down by 20 basis points. The US is down by 6 basis points. Germany is down by 2.8. Italy is down by 2.6. So you're not getting the big reaction that you're seeing in Japan, Kriti, in Europe this morning. But you're getting a little bit of it in the United States in the long duration story.
Absolutely. I'm curious if that changes as we go further and further into the session, perhaps even get the gilts open as well. In the meantime, let's zero in on that story that Guy just mentioned. Japanese super long bonds, as he said, have rallied after Bloomberg reported the finance ministry sent a questionnaire to market participants regarding appropriate issuance amounts for government debt. Meanwhile, BOJ Governor Kazuo Ueda signaled his intention to continue raising rates if the economy improves as expected.
To the extent that incoming data allows us to gain more confidence in the baseline scenario, we will adjust the degree of monetary easing as needed to ensure the achievement of the sustainable 2% inflation target.
For more on this, let's bring in Bloomberg's Brian Fowler to give us a little bit more perspective. Brian, in some ways, the comments by Ueda seemed fairly in line, including the pledge to hike the rate if those conditions allow. But walk us through why the yen rose in response to those comments.
Yeah, so I think context is key in this point. At this point, in recent weeks, we've seen perceptions about the prospects for a BOJ rate hike swing wildly. That started especially with May 1st when the BOJ cut its forecast for inflation and growth. And those downgrades to the outlook were due largely to concerns about the potential impact coming from tariffs. So all notions of a near-term hike pretty much faded quickly right at that point. Then we saw the U.S. and China do a deal on tariffs, and optimism came back into the market. That brings us to today. And as you said, what Ueda said about raising hikes if conditions allow is pretty much a reiteration of standing policy. But he also said that we are right now closer to reaching the target than at any time in the last 3 decades. Now, in some ways, that's a statement of fact. We had data last Friday showing that consumer inflation in Japan has now been at or above the BOJ's target for exactly 3 years. We'll get more data this Friday, Tokyo CPI, a leading indicator showing that trend will easily extend. But the fact that Ueda chose to point out that we're closer to the target than any time in the last 30 years, I think that's what got the market excited, and it's definitely a choice he made to send a signal.
Is he sending a signal that a hike is coming and a hike is coming soon?
I don't think it's coming soon. The next decision is on June 17th, and most economists we've spoken to don't expect any kind of move there. The focus on that date will be the new updated plans for BOJ JGB purchases, which will show how with the pace of QT going forward. But there are perceptions that the BOJ could hike rates sometime in the third quarter. September especially is a date that about half of economists see a hike by.
Brian, so thinking about rate expectations in Japan and where we see interest rates rise, or when we see them rise, is part of the interesting narrative coming out of Japan. The part that's kind of caught the market's imagination, though, seems to be around what the Ministry of Finance is doing. We've seen these reports that the Finance Ministry is talking to the market about bond sale amounts. And how does that fit with what the BOJ has been saying and, in fact, doing recently?
Yeah, so this is a super hot topic, and again, context is key. We've seen long-term yields soar in recent weeks, and part of that's global, but also a large part of that is concerns about the pace of BOJ's QT as it pulls back from the JGB market by curtailing its bond purchases. That's something the BOJ right now is doing. It's updating its plans, and as I just said, we'll see the updated plans on June 17th that will, for the first time, tell us what pace the BOJ will cut its JGB purchases at in the next fiscal year. Now, MOF is coming from the other side, the supply side of the equation, looking at the same problem, trying to talk to the market to get a sense of what the market thinks can be absorbed in terms of issuance. So the BOJ and MOF are very much on the same page. They're looking at this problem of soaring long-term yields and they're trying to come to some kind of understanding of what the market really can sustain in terms of issuance and what they can do in terms of replacing the BOJ as a big buyer of JGBs.
Brian, thanks very much. Bloomberg's Brian Fowler with the latest on that Japanese market dynamic. And sticking with news flow coming through to us from Asia, China's industrial firms saw their profits increase at a faster pace in April. That's as a government trade-in program drove demand for manufactured products in the face of pressure from higher US tariffs. Joining us now to talk about China and its prospects amidst the ongoing trade conversations, Diana Choi-Lever, Chief Economist at Inodo Economics. Diana, very nice to speak to you once again and think about where China goes from here. I wonder how patient you think China can afford to be when it comes to trade conversations with the United States. We've seen in Geneva a couple of weeks ago, China and the US came to a better understanding, at least in the short term, on tariffs, but they're still talking. How patient can China be?
China can be a lot more patient than the US in the short term. Clearly, both sides were hurting, and that's why we saw them pulling from the brink in Geneva. But ultimately, it was America that blinked first, because in the short term, China has a lot more economic leverage, as well as political resilience in terms of the impact of the trade war on its own economy and population.
And talking about that resilience then, Diana, does it mean that the Chinese economy is going to take on any new shape at all, or would you expect it to look pretty much as it has over the last 5 years or so? I ask this because in a new 5-year plan, we're expecting for the Chinese to want manufacturing to stay constant as a percentage of GDP. That doesn't sound as if it's moving in a direction that the US administration would want it to.
Look, actually, September last year saw a dramatic U-turn in China's economic policy. Up until that point, it was all about supply-side transformation and, as they call it, new productive forces. While self-sufficiency is still very much the focus of China's industrial policy, they have finally realized that they really need to get consumption growing. Consumption growing as a share of GDP, so it becomes a growth driver, in particular because they do not expect the external environment to improve dramatically, certainly with respect to the US economy. So no, if they are successful at this transformation, and they've been talking about this for years, but they're finally just about doing some of the right things to get consumer spending going, then the shape of China's economy over the next few years will be different.
Diana, it's Kriti in London. We've been monitoring this idea of front-running that tariff risk. Yes, there may be a brief pause at the moment, as Anna mentioned, as you just discussed. But there's also a question here of the fact that there's such a rush internally within China to get some of these exports to the ports, and yet they aren't actually hitting U.S. shores. And you've seen that in some of the trade data that's come, especially since that trade agreement, or the Geneva mechanism, I should say. We're showing that chart on the screen right now that hasn't shown that kind of recovery. In that context, where are Chinese exports going as you kind of see this rerouting of trade?
Look, China has had 10 years to work on its response, and it has put a lot of effort into developing new markets. And some of its exports are going to the global south, and that is something they'll continue to develop. But at the end of the day, it really is domestic consumption that matters the most for China. And it has to become the sort of consumer first resort for its geopolitical sphere of influence. There is no one else on the horizon that could really fulfill that role for China.
Dana, good morning. It's Guy. I'm also reading a lot of stuff, though, about the fact that Xi Jinping is channeling a lot of what Mao had to say, and this whole idea that you see this kind of long grind that China should be able to tough it out effectively and sustain itself that way. Does that speak against this idea that you are going to see this consumption boom, which seems to be sort of ideologically different to the way that you would think about it if you see it through the Mao lens. What message should we be taking away from what the CCP is saying right now and what Xi Jinping is saying right now?
Look, at the end of the day, China is fully committed to creating its own self-sufficient sphere of influence, and it realizes perfectly well that whoever wins the tech race is going to be the hegemon of the future. So it is throwing everything at innovation and trying to continue to lead in the sectors and new technologies that it already leads and gain pace in others, either through finding new paths or managing to catch up in the US in areas where it has long competed but lagged behind. So that remains very much a critical part of the way they see the future. But there has been a shift in the way they look at demand and in the type of structural changes that they are engineering in their economy to support consumers. Now, it remains an open question whether they will succeed, but there has been an ideological shift in that sense.
But so what is the message to Chinese consumers right now from Beijing? What are they telling Chinese consumer to do? Are they telling them to go out and spend? And do you think that message is getting through at this point?
So they engineered, as we heard when you reported on the industrial profits, a major trade-in program. And if that was all they did, I wouldn't have been particularly encouraged for the long term, but clearly it has had some support over the short term. What else they're doing is that really trying to lower costs, both in terms of education and medical care, trying to deliver all the undelivered properties, also provide affordable housing, so they remove that kind of uncertainty from consumers, certainly at the low end. And simultaneously, they have actually abandoned the housing is for living and not for speculation mantra. So they are allowing at the top end the housing market to behave like a normal market, which hopefully will stem some of that huge precautionary increase in savings. So on the one hand, they're trying to lower the savings rate, and on the other hand, they're trying to boost real incomes, largely by lowering costs. But of course, with the export sector likely to be under continued pressure over the course of this year, they're also extending support, in particular employment support, and trying to redirect some of these exports not just to other global markets, but also to internal consumption.
Diana, very quickly, there's a quick question in terms of Europe here, simply about whether there is a risk of Chinese overcapacity into European markets. 30 seconds, Diana. What's your take on that risk?
Look, China does have overcapacity. They are actually absorbing quite a big chunk of it themselves, which is all these trade-in programs. But of course, Europe is a key market for them, and they see an opportunity now strategically, geostrategically, with respect to how Trump is negotiating with Europe to maybe achieve their long-term goal of having Europe sort of neutral to China, if not within China's sphere of influence. So they're likely to negotiate and cooperate much more on Europe and address some of those concerns on kind of Chinese dumping their excess production on Europe.
Diana, great to catch up. Thank you very much indeed. Diana Chorleva, Chief Economist, joining us from Inodo Economics. Talking of Europe, we are seeing French CPI dropping onto the screens right now. Looks, on the face of it, to be a little softer than anticipated. Certainly the year-on-year number coming through at 0.6 versus a 0.9 prior and a 0.9 survey. The month-on-month number looks soft as well. So, yeah, French data coming through, maybe making the case for more ECB rate cuts.
Absolutely. Seeing a 3 basis point move, by the way, on the French yield. That is since that bond market opened. Coming up on the program, iron ore is one area of the market we haven't talked about yet. Those prices sliding this morning. We're going to discuss the outlook for the mining sector next. Your stocks to watch is coming up. This is Bloomberg. Welcome back to the opening trade. Let's talk about the bond market here. Of course, that's what's driving these markets, at least over in Asia and in the States this morning. We're waiting for a more pronounced reaction in Europe. But as we are about 10 minutes away to the European Open, I thought I'd combine those two narratives. What's going on in the bond market and what's going on in the stock market, at least in terms of this chart that caught my eye. This is courtesy of Cameron Kreis, who, of course, writes our Macro Man column over in the States. But he made an interesting point over the last couple of days. He looked at the daily correlation of three-month daily correlation of changes in the 5s, 10s curve and the S&P 500 and kind of put those together. And you can see that we're at some pretty acute levels that we have not seen going back to the GFC and before that, 1987. What does that tell you about how much stress this market is facing? But Anna, I have to point out, he made this point in his column as well, this idea that in those previous iterations, it was really coming from rate cut expectations that was driving these kinks in the curve. This time, we're talking about bear steepening on the fiscal side and no rate cut expectations in sight, and yet the same result. Something to ponder as we talk about the bond and stock market.
Yeah, absolutely. That relationship between yields and stocks very much in focus for us, driven as they are those concerns about the fiscal side of things. Kriti, let's continue with this conversation and talk about the markets in 3 minutes with our Markets Live executive editor, Mark Cudmore. And the long end of the bond market is certainly getting our attention then, Mark, when it comes to Japan, also feeding into treasuries, though. 30-year treasury yields we see down by 7-8 basis points right now. US stock futures, to Kriti's point, pointing higher. They were higher on trade narratives, but maybe also higher then on expectations of slightly lower yields.
Yes, I think there's two different aspects here. First of all, I think the price action in the bond market, despite the fact it's a very sharp rally, is very worrying for bond investors. It shows kind of how nervous this bond market is and how low the liquidity is. You know, we always say about stock markets, the bear markets see the most powerful short-term rallies. And now we're seeing that in a bond market. And I think it confirms the fact that we are in a structural bear market for long-end bonds. I do not know how long this kind of relief rally in bonds will last. It may last for days or even weeks, but it is quite worrying, and I think that we're going to have much higher yields again later on this year because it shows this is a market that is very nervous around the bond market, even if they got over their skis. Now, we are seeing the fact that equities are rallying in the short term. Is that because we're getting lower yields, or is that just, again, a little bit of the low liquidity relief rally on the fact that Donald Trump, reverse decision on EU tariffs has delayed the kind of imposition of 50% and said that trade talks are accelerating, in the fast-track program. So I think it's more just low liquidity. We're over-interpreting that signal. I expect that later on this week that we'll resume the Sell America trade. Whether it starts before the Nvidia earnings or not, I don't know.
Mark, latest thoughts on the dollar? Christine Lagarde thinks this is the euro's moment.
I think we shouldn't over-interpret kind of her point. I mean, it's true. The dollar will be in a long-term downtrend now. The world is overexposed to the dollar. Dollar share of global reserves as of the end of last year was 57.8%. That'll probably fall to below 50% in the next coming years. We've been in de-dollarization for the last few years. It's just very, very subtle and gradual. This is not about the end of the dollar. The dollar will remain the world's reserve currency. It's just about reducing exposure. So we're in a long-term dollar decline. However, the euro is not going to surpass the dollar as the world's reserve currency. The dollar is firmly entrenched. It's just about a smaller share of dominance. But yes, of course, the euro will benefit from that de-dollarization. It'll be one of the many currencies that will benefit from the fact that we are in a structural dollar depreciation trend. But that does not decide the short-term trading. And in fact, the very short-term price action, again, suggests that FX traders, the short-term traders, have got too bearish the dollar. We might get a bit more of a squeeze in the very short term. But people will sell rallies aggressively in the dollar.
Very quickly, where is Eurodollar going by the end of the year?
It's going to go to 130 before 106. But, in the timeline, will that happen this year? Probably not quite this year. But I think that the next 10% move in Eurodollar is higher, even though the last 10% was also for a higher move.
All right. Bloomberg Markets Live executive editor Mark Cudmore giving us his take on the markets this morning. We thank you so much. You get more update analysis from him and the team. ML Ivy Go is the function on your terminals. Get our stocks to watch now from Joe Easton. Joe.
Morning, Kriti. So we're watching Spanish banks today because we might get a decision very soon on the takeover of Sabadell by BBVA. So the Spanish bank is going to decide whether to put this deal into a review. They cannot actually block BBVA from buying shares in Sabadell, but potentially could put conditions on a takeover, and that could be key. We can see that rally in Sabadell over the past year. It's been around a year since we got news of the interest in BBVA, and that stock has actually doubled in terms of Sabadell. Keep an eye on that one today. Then defence potentially going to see a move higher in the UK names, which are going to likely catch up with the move that we saw yesterday. There is actually a note out from JP Morgan predicting further gains in European defence stocks, given the focus on the NATO summit that is coming up soon. Keep an eye on BAE Systems in particular for that one. Then finally in miners, bit of a drop down in iron ore overnight. We're down around 2%. Most of the focus is on oversupply in Chinese steel. Keep an eye on the UK miners in London today.
Joe, thank you very much. Joe, with the latest on the movers. We'll be back with the market open shortly. This is Bloomberg.
Welcome to the first full trading day of the week. The UK is back. The United States is going to be back a little bit later on. Yesterday, Europe was open. It had a chance to price in some of the stories that we had over the weekend, which related to the stories that came before the weekend. Anyway, let me basically try and simplify all of this. And the way that I'm going to try and do that is by looking at US futures over the last 3 days, 2 trading sessions. So this is the end of Thursday. This is where we came through Friday. Nothing happening. Then you get the 50% tariff threat. Equity markets go down pretty sharply. Then you come through into Monday, and that tariff threat has been removed, and you see a bounce back to basically the same level. Since then, in US futures, we've climbed a little bit, up by circa 1.2% over the entire period. So we are up when the US returns on Monday morning a little bit, but versus Thursday's close, we're up by 1.2%. It's confusing, I appreciate. Europe had a chance to price it yesterday. Kriti's going to tell us how the UK is pricing it this morning.
Well, it's the catch-up trade, and I think it's as clear as that, because you are seeing cautiousness, you are seeing virtual, basically unchanged market when it comes to Euro Stocks 50 futures, and the CAC, of course, being the underperformer. But just look at the margin that the FTSE 100 has to catch up to. So, Anna, my bet here is that today might just be a little bit of a catch-up to the news Guy was just talking about.
Yeah, so London might stand out for that reason. We'll keep an eye on that. A number of sectors that we're watching today. Watch defence stocks. Joe Easton was talking about this earlier. NATO talking about getting to that 5% of GDP defence and associated spending. We'll watch that. Mining stocks in focus. That could weigh on London a little bit as we see, for example, iron ore prices just a little bit weaker this morning. And bank stocks in focus. A deadline approaching in Spanish bank M&A. And we also see job losses at HSBC. A number of reasons, guys, to watch that sector.
We're going to watch that very, very carefully. So basically, Euro Stoxx futures going into the session here in Europe, that's the European side of things, are unchanged. So I don't think you're going to see much action at the get-go of trade this morning when it comes to the markets that were open yesterday. The London market might be a little bit different. It has to play catch-up. To what extent it does that remains to be seen. But we're up by around 0.2% currently on the FTSE 100. But the Stoxx 600 comes through absolutely flat as anticipated. It's already, to a large extent, priced in the move, the recovery move that we saw versus Friday. So you're getting no action there, but the FTSE 100 still has to play that catch-up trade, as Kriti was indicating. CAC's down a little bit, 0.1%. The IBEX is down by 0.2%. The DAX is up by 0.1%. Kind of all netting out basically to a very flat open for Europe, excluding the FTSE 100, which is up by, let's call it, circa 0.8%. Kriti, sectors?
We're not seeing a real kind of sectoral trade here. I'm just looking at the movers that were the outperformers yesterday, at least in the European trade, are the underperformers today. And yet you are seeing broad gains, but again, marginal ones. So I wouldn't read into this green on the screen in terms of kind of an overarching positivity or bullishness, Anna. But I think it is notable that a lot of the underweights this morning, or the kind of ones that aren't rallying as much, are based in France. You can see in the CAC 40 down about 0.2%, we'll call it. LVMH a big part of that trade.
Yeah, you're certainly going to find more of the UK-based businesses to the top end of things, aren't you? And I'm just looking at the best performing sector, which is real estate, and there's a lot of PLCs in there, so there's a lot of London catching up with yesterday's gains. But I'd also throw in the fact that we're seeing lower long-term yields, and real estate, obviously, and this is away from the UK narrative, but globally lower long-term yields. And I wonder if the real estate sector is responding a little bit to that, because we've witnessed, of course, some substantial movements at the long end. And I'll add in the UK there, because we are seeing that the UK 30-year yield, I think that is today's, yes, we are seeing the 30-year down by 6 basis points. So that is something that can boost those real estate businesses.
Yeah, but they are dealing with what seems to be a very sticky, and I appreciate we're getting some movement this morning, longer-term story. Rheinmetall is up quite strongly in terms of the points that are adding. We are seeing the defence story coming through. That maybe is a feed off what we're seeing with the Friedrich Merz narrative around allowing long-range missiles to be used in Ukraine and fired into Russia. I wonder whether there's a reaction there as well. HSBC is up, Rolls-Royce is up, BAE Systems is up. The defence story, therefore, is actually having a fairly good morning this morning. We were looking earlier on for maybe some narrative around maybe the mining stocks coming under a little bit of pressure. I don't necessarily see that this morning. Rio is off. It's off a little bit. Let me just narrow it down by around 1% this morning. So there's some weakness coming through. But there's definite weakness in the luxury sector this morning, as you say, Kriti, out of France.
I wonder how much of that is simply kind of a hangover from the tariff trade or even some of the China's data as well. It just, this market feels like something is just kind of shaking out, catching up to the news, and maybe is on equal footing when it comes to tomorrow. Maybe we'll see a little bit more there. We also should keep one eye on the bond market as well, though, because you are seeing that bid into the bond market is certainly more pronounced. We'll get to that in just a moment. But let's bring our markets guest in this morning. Nancy Curtin, CIO at Alti Tiedemann Global, joined us around the table. Nancy, a pleasure to have you on the program. We're seeing perhaps a bit of a cautious trade in the equity picture this morning, but certain panic, it feels like, in the bond market. That volatility perhaps responding to questions or whether around whether the American exceptionalism trade should still be there. Your thoughts?
Look, a bit like Mark Twain, the death of America is greatly over-exaggerated, as is the dollar. Having said that, we have believed that the term premium will rise in the United States. In other words, the compensation that investors demand for taking a position in longer-term governments in the United States, we not only have the fiscal challenge, and we have that tax bill winding its way through Congress, but we have perhaps a bus, which is anything but the United States. In other words, at the margin, we do believe that foreigners will think about their allocations to the United States, not sell it all, but maybe allocate less or hedge. And we think that has implications for both a lower dollar and or a higher cost of capital, both of which we're seeing at the moment.
So don't underwrite America.
Don't.
Why?
Because, look, the innovation and dynamicism of the economy, and also we only have Trump for another couple of years here on top of that. So there's huge amounts of, I think, great viability in the United States. And, of course, Gen AI didn't die in the last 4 to 5 weeks, and the U.S. is the clear leader there. Look at the deals that happened coming out of the Middle East when Trump was there about a week or so ago. So, yeah, don't underwrite or write off the United States, but we do believe in a higher cost of capital in the United States. That's going to be part and parcel of what Trump will need to deal with going forward.
A higher cost of capital, and that takes us to what's going on at the long end of bond markets today, looking very different to Thursday. Thursday last week, we saw this surge at the long end, and that was Treasuries, it was JGBs. So this is something of a global story. But thinking about the US, can the markets, or will the markets, focus once again on that, or can the markets move on to think about growth? Because in that same tax bill that got everybody worried about the fiscal position, there were also things that you could get excited about growth if that's where your head's at.
Well, funnily enough, while we're worried about the term premium rising, we also think the tax bill is pro-cyclical. And within that tax bill, I think there's a couple of things to comment on. Number one, it's better off we have the tax bill going through than not. Otherwise, taxes would go up for 80% of Americans. That would not be a good thing. That would be a bit of austerity to come. Number two, within the tax bill, as you sort of hinted at, is embedded a lot of incentives for companies to invest. Bonus depreciation, expensing of R&D, and increase in deductions for interest costs. These are pretty positive from an investment spend perspective. And by the way, if President Trump does get through a baseline of tariffs, call it 10 to 12%, and makes them permanent over the next decade, that would raise something like $3 to $4 trillion. Again, that's the number that gets added from the tax bill. So, again, I think there are some counterbalancing influences, but you're absolutely right. The tax bill is pro-growth, pro-cyclical, and we think investors will focus on that as well.
In terms of those incentives for global business to invest in the United States, then, Nancy, are these, should we get excited about that in the context of the IRA tax incentives being removed? You're citing other ones here, and there's so much detail in this tax bill. I mean, are we going to see that being enough to offset businesses' nervousness around an ever-changing tariff environment?
I mean, it is hard to say, but at the moment we've seen about $2 trillion plus of announcements. Okay, announcements is not the same thing as breaking ground, but to invest in increased production in the United States. That, in combination with the tax incentives, are positive for investment. Of course, we have to time box this uncertainty. We've got to get through a number of different trade deals. And remember, tick-tock, we have 43 days here left until July 9th. So, you know, we've only had the UK so far. We need to see some progress on these trade negotiations as well.
Can Americans continue to buy equities when the rest of the world isn't buying the same equities? What is the trade here? At the moment, it feels like every time there's a dip, US retail steps in and buys. That is the muscle memory that has existed for the last 15 years or so. It has worked. It continues to work. It's continued to deliver. Is that still the trade? Because I'm hearing a different message from US retail, from US institutional, and from external investors as well. They're all seeming to think different things at the moment. But US retail continues to buy. Is that the right trade?
Well, thank you, Mr. Retail, because that's what brought the market back up again, nearly 17%, give or take, really, from the lows. You're right. We are cautious. Institutions are cautious at the moment. But cautious at the moment because we've got a lot of headline risk. We've got a tax bill. We've got tariff negotiations. We have a debt ceiling. We have a lot to get through in the next couple of months. Having said that, it's been our view that the U.S. will slow but not go into recession. There's a number of different shock absorbers, the wealth effect, still strong jobs market, tax deregulation. Gen AI, as I said, didn't die in the last 4 weeks. So we do think there are some significant counterbalancing influences that we think will keep the U.S. on track, and we think earnings growth will actually prove to be more resilient than investors think. So maybe Mr. Retail isn't wrong over the longer term.
Can everybody be right at the same time? And I ask this question. The euro is a massive... The dollar is a headwind now for international investors. Yes. I keep coming back to this. When you have conversations here in London, are they different to the conversations that you're having over in the United States? At the moment, in the United States, the economy looks OK, things are ticking along, equity might go up a little bit, but if I back out the dollar trade, then I'm actually, as a European investor, lower. Can US retail benefit and see a market that rises gradually and keeps going, but the rest of the world has a different perception of that market because of the fact that you put an FX overlay on it, which is much more negative?
Well, for our clients, we are looking at hedging what we call parts of the portfolio, like bonds and credit and infrastructure, things that we think we want to make sure are hedged back to base currency for our clients. But with respect to global equities, pretty hard to hedge. I mean, Microsoft, I don't know, how would you hedge that? It's got global revenues in lots of different places in the world. More importantly, when the dollar declines, and it's down about 7-8% so far year to date, that adds about 4% to earnings. So a lower dollar isn't necessarily negative.
Do they counter each other? Because you can argue the other way around.
50 basis points. So let's say, 8% decline is a 4% add to earnings. So that's a good thing. We had the largest buybacks almost in history in the first quarter, $550 billion. And remember, those tax incentives that I mentioned is like equivalent to a corporate tax cut. So there are some things that are positive here. But you're right. At the margin, as I said, we think foreigners are going to think about their allocation and certainly hedge part of their exposure to the United States, certainly in government bonds.
Sure, restructuring, and that's, I feel like that happens cyclically every, 5-10 years, pretty much?
I think this is really a very significant shift, because over the last 2 decades, it made a ton of sense to own America. The dollar was rising, every asset class was underperforming. If you weren't overweight America or had a very substantial position, typically unhedged, you were hurting in performance terms. So we think this will get unwind. And this has, as I said, implications for perhaps a lower dollar and a higher cost of capital for the U.S. That's the price of Fortress America.
You mentioned the bond market specifically. That could be kind of the straw that breaks this camel's back. There's a question right now of just how much domestic, not just buyers in terms of pensions and endowments, but the banks themselves can absorb some of that supply if we do get to a point where Scott Bessent does have to ultimately tap more, and the bond market can get a little bit more issuance there as well. To the folks you're speaking to, is that absorbability a concern?
I mean, remember, there's deregulation on the horizon, and if they lower the SLR rate for, for banks, they could buy more government bonds, because right now, if they buy government bonds, they get a sort of risk, capital charge. So that could be something. I think there's also, Scott Bessent's been thinking about, okay, could Europe buy a 100-year bond as a way of exchanging for increased defense spending or security from the United States? So I have a feeling that there are things up the sleeve of the administration to absorb. And remember, household wealth is still, kind of $70 trillion and counting in the United States. So there's a lot of wealth there to buy into the debt. But you're right. We do think term premiums will rise.
But what do you do in the intermediate? I mean, there are gaps between the tax bill that gets potentially passed through the Senate, ultimately debt ceiling in July, the issuance, the SLR changes. These are all pieces that could, and then trade deals on top of that. There are lags in between. They don't all happen at once. What's the trade in the intermediate? In between those gaps?
Stay still. One thing we've learned from what happened in April and now in May is that trying to trade, and last Friday, trying to trade these markets is fraught with uncertainty. There's a lot of wealth being vaporized for people that are going down, and then the markets go back up again. We say to our clients, you're long-term investors, stick with the plan, stick with your asset allocation, and don't try to trade these markets. And by the way, we're global investors, so we have the U.S., we have international markets, which have done incredibly well, so that diversification is the best risk mitigant during this particularly turbulent time. But yes, caution near term in terms of markets.
Nancy, thanks for stopping by. Really nice to see you once again. Nancy Coe, CIO at LT Tiedemann Global. Let's take a quick look at the core six. This is what the picture looks like. We find ourselves in a situation where you have two different markets, effectively, the UK market versus what is seeing in the rest of Europe. But there's some diversification within Europe. Luxury is under maybe a little bit more pressure than we are seeing elsewhere. As you can see, you've got LVMH trading down nearly 1% this morning. What else are we watching? Let's find out. Joe Easton's back with some details.
So we are seeing some movement in the defence stocks. Guy, as you mentioned, kind of two different stories in Europe today with the UK catching up. So we've brought up the UK names because BAE Systems, Kinetic, Babcock, all of the UK-listed defence companies kind of catching up with what we saw yesterday with that move higher in defence stocks. Rheinmetall was up around 3%, and there is focus again on the NATO spending, potentially countries coming up to 5% of GDP. Will that actually be confirmed? We have got a bit of an upgrade for Kinetic or Kinetic Q over at Kepler. So the UK company's kind of doing that catch-up trade this morning. Then we've also got some watchmakers on our radar. Now, the watch numbers out of Switzerland actually look pretty good, up around 18%, as we see down the bottom there in the latest quarter. And the US numbers, Americans buying loads of fancy, expensive watches, according to that data, because actually the sales almost doubled on a year-on-year basis. Potentially there was a little bit of a comparative issue with that data, but the stock's coming down a bit, potentially kind of due to the weakness we're seeing in broader luxury, as Guy mentioned a moment ago, which does bring me on to the luxury movers. We have also got LVMH slipping a price target cut over at HSBC, and HSBC actually talking about a weaker US consumer continuing to wait. It's kind of in line with the other commentary we've seen from the conferences in recent weeks. Luxury, the outlook in general, still looking a little bit soft, and broadly as well, Kering and Moncler coming down. The one stock outperforming in luxury today is actually Burberry, upgraded over at Barclays this morning. They reckon that the cost savings at the company, we saw headlines on that a few weeks ago, potentially going to boost Burberry. So that one doing pretty well. We're up 1.7% for Burberry this morning. Then in chemicals, we have got news of a bit of a legal issue for Clariant, getting a lawsuit from OMV saying that they're copying some of their copyright or some of their rights or patents to a certain chemical that is used in making plastic. Very glamorous in terms of that market, but that is weighing on Clariant over in Switzerland. We're coming down 1.5% at the moment on that one. A bit of weakness in chemicals today. And then finally, the maker of Panadol and other painkillers, Sensodyne toothpaste, I think they do as well. Haleon upgraded to outperform over Adexane. That's a spinner from GlaxoSmithKline, of course. That stock has rallied, but they reckon that it could come up to 500 pence a piece if they hit their profit targets. So Haleon in the painkiller market up around 1% in London this morning.
Thank you very much, Joe Easton from our equity team with a look at some of those stocks that are moving. No pain in gilt markets this morning, really taking its lead from, I was going to say treasuries, almost identical to what's going on in treasuries, but they in turn taking their lead from Japan. So we see yields on the long end of the gilt curve down by 8 basis points, and that's 30, 40 and 50-year, of course, here in the UK, and really echoing the 30-year move in treasuries then, down by 8 basis points, Guy, at the long end of the US market.
Coming up, we're going to be talking about what is happening with the European car sales story, slipping in April. Major markets, including Germany, France and the UK, all posting declines. I think BYD may have overtaken Tesla. You want to take a look at that data. We'll do it in more detail next. This is Bloomberg.
Welcome back to the opening trade. We are 20 minutes into our European session that sees the London market playing a little bit of catch-up, up by 0.6%, while the rest of Europe pretty much flat, either side of the flat line in the German market and the French market. Now, let's turn our attention to some corporate news flow, though, that has made headlines. Bloomberg has learned that HSBC has cut more than 24 analysts in recent days as Europe's largest lender deepens a restructuring of its investment banking businesses. Sources say that the cuts, mostly in Europe, include the departure of Stephen Major, global head of fixed income research. For more, Bloomberg's Steve Aarons joins us now. So what's happening here, Steve, and what's the driver?
Well, as you said, there's restructuring going on. There's a new CEO who came in last year. He's trying to cut costs, and so job cuts are clearly part of that cost-cutting drive. Even though the roles we're talking about a few dozen here. It's not a huge number. Remember, HSBC is a vast bank. But, as you also said, it involves some really senior people and clearly shows that he's taken, the new CEO has taken, a very harsh approach to his cost cutting.
But why now, Stephen? This has been a dynamic that's been in play for quite some time. Why now?
You know, the new CEO came in September. He unveiled a sort of new strategy involving an efficiency drive in October and has since then repeatedly involved new measures, including sort of investment banking cuts earlier this year, also targeting Europe. So it's a continuation of that drive that focuses on sort of streamlining HSBC's presence in Europe, focusing it more on Asia. And this is clearly part of it. As you said, the roles, most of the roles that are to go will go in Europe. And so he's taken step after step to achieve his goal.
All right, Stephen Aarons walking us through the dynamic at HSBC. Those shares higher by 0.6%. I'd say part of that's a catch-up trade, part of that perhaps responding to this news.
Let's turn to the auto sector and figure out what is happening there. European car sales data dropping in April amid weaker economic growth and uncertainty due to global trade tensions that's prompted consumers maybe to hold off on larger purchases. Bloomberg's Danny Lee joins us now on the details of what we've learned. Work us through the numbers, Danny. Talk us through what these numbers tell us about what demand looks like. Bigger picture. We'll get into the specifics of the individual companies in a moment.
Yeah, good morning, Guy. This is largely bad news. For the third time in 4 months, we are seeing a decline in sales across Europe. It's a big, major market, and when you look further deeper into the picture, it's some of the big markets which are slipping, such as Germany, France, and the UK. So it is a bit of a struggle. Given the broader macroeconomic backdrop, the slowdown in growth, and the uncertainty around tariffs, which is really kind of dogging the picture for consumers and thinking about making large purchases. So there is a challenge there, and it's not a good time for the European automakers and the European auto sector when they're having to confront challenges from Chinese competition and then these tariffs from the US.
So, Danny, what about the Tesla dynamic? Because we know from reports we've seen already that Tesla has been struggling in Europe. Is that held up again? Is that something that's happening once again in this monthly report?
Yeah, Tesla falling, sales falling by half, so down to 7,200 units. And that compares with the overall picture in Europe when we saw sales slip 0.3% to 1.08 million units. So, Elon Musk has been very robust in recent times, saying that this sales collapse it's seeing in Europe is just isolated. But when you look at the broader picture, its peers are not suffering the same kind of declines. And so, for Tesla, it's a blow. And kind of the watershed moment that we have seen is that the likes of BYD, China's BYD, a big competitor to Tesla, has managed to overtake Tesla in sales according to some market research data. And then when you look at some of the official data from the ACEA, SAIC Motors, a big Chinese state-backed automaker, has also managed to overcome Tesla in sales year to date so far. So it's a big turnaround and not a great looking one for Tesla at the moment.
Danny, very quickly, give us the update on Volvo Cars.
Yeah, Volvo cutting 3,000 jobs, so 7% of the workforce out of 44,000 workers. So it's a big restructuring they're undertaking, given their struggles in earnings. They're trying to make these cuts to get ahead of a weaker profitability. They missed out on earnings a couple of weeks ago, and they are going to have to confront real challenges with US tariffs as well. So that, along with weakened consumer demand, under new management, they are really having to take action, and this is part of a broader 18 billion Swedish krona plan to try and stop the Volvo ship from sinking.
All right, Bloomberg's Danny Lee walking us through the car-making story, both of Volvo Cars and BYD and Tesla as well. We thank you so much for walking us through that story. As Danny was speaking, we should just get a quick check on these markets here, because when the bid for the bonds, at least in the States and over in Asia, were intensifying, futures in the meantime picking up as well.
Yeah, absolutely. That link does seem to be playing out, doesn't it? Even if US futures were initially higher on optimism around trade, the fact that we're seeing those long end yields coming down from Japan to the UK to treasuries, that does seem to be pushing futures a little bit higher. NASDAQ futures up by 1.5%, which is a good 0.5% higher than they were at the start of this programme, I think.
Yeah, we're certainly seeing a little bit of a pickup. I don't think you're seeing much of a pickup. If you take a look at the 3-day chart, we're basically kind of where we were throughout most of yesterday's session. We've picked up a little bit versus Friday. So I don't think you're not seeing that much action in this market just yet. A little bit.
Coming up, we'll focus on some of the geopolitics playing out in Eastern Europe. Ukraine's Western allies are trying to intensify pressure on the Kremlin. We'll be joined by sanctions expert Tom Keating. That conversation coming up shortly. This is Bloomberg.
This is the opening trade. About 30 minutes into today's session, we are seeing green on screen across the board, but perhaps not by the massive margin that we were expecting, unless you look at the FTSE 100. A little bit of a catch-up trade there right here in London, higher by about 0.6%, but starting to see that sentiment at the open. That was at least 30 minutes ago. Was a little bit softer, now higher by 0.2%. I guess you can call that a little bit of bullishness as well. One sector that stands out, of course, is going to be the defense sector. And we are seeing some major gains when it comes to that. Perhaps the news around Ukraine and the green light out of Germany moving those stocks.
Absolutely. Let's talk about where that is coming from then, the impetus for those moves. Chancellor Friedrich Merz says Germany is no longer imposing range restrictions on weapons supplied to Ukraine, bringing it into line with the United States and the UK. It comes as Kyiv's Western allies attempt to intensify pressure on Russia after it launched its biggest drone barrage against Ukraine since the full-scale invasion over 3 years ago. Let's bring in Bloomberg's Russia economy and government editor Greg Sullivan, who has details of what's driving this change in stance, perhaps from Germany. So, Greg, what's the significance of this move by Friedrich Merz, and how much does it likely help Ukraine on the battlefield?
Well, it's a pretty significant move, this widening, lifting the limits on ranges that they can use German-supplied weapons. It's something that Ukraine has long been asking for. Ukraine wants the capability to degrade Russian military force within Russia's own borders. That's striking things like airfields, weapons storages, oil and fuel depots that aid the Russian war machine and its ability to attack Ukraine. This move by Germany also puts it more in line with the U.S. and the U.K. The U.S. has allowed Ukraine to use its ATACMS missiles, while the U.K. has allowed its Storm Shadow missiles to be fired into Russia. So that sort of more aligns them with other Western powers. But it also raises the risk that Russia will see this as a provocation. Already yesterday, we heard from the Kremlin that they said that this was a dangerous move and likely to widen the conflict. And there are also other questions that remain. While it's likely to help Ukraine, that would depend on how much weaponry Ukraine has. What are its long-range weapons supplies? Will it receive more supplies? So far, Germany has refused to provide the Taurus missiles, those long-range missiles, to Ukraine. So still a lot of questions even after this announcement.
Well, Greg, that green light is something that was already given by, I believe, the Biden administration previously as well, I think last year in terms of those long-range attacks as well. How is this different, or how does this expand the story from the broader pressure likely coming from NATO?
Well, there's a few things here. You're right that the U.S. has given the green light to Ukraine, and of course they've in the past used the ATACMS missiles in the Kursk region. But now there's the broader question of what kind of U.S. supplies will still remain with the Trump administration. Obviously, Trump has suspended military aid once before resuming supplies. There was obviously questions about whether there will be new supplies. Trump has been very critical of aiding Ukraine during this military conflict. And in the broader ceasefire negotiations, now it's looking as if Trump has given signals that he may be willing to walk away if there isn't broader progress. And so far, there hasn't been progress in the ceasefire. So those questions remain from the U.S. side. And now we have Germany saying, well, potentially. But again, if there is no German weapons supplies that are long range, it's unclear what this exactly means on that front.
Yeah, we still need some details. Greg, great to catch up. Thank you very much indeed for updating us on what is happening. Greg Sullivan joining us on the, let's call it the kinetic side of the equation of how the West is responding to Russia. Let's continue that theme, but maybe from a different angle. The US President Donald Trump has said he was, quote, absolutely considering new sanctions against Russia following intensified attacks on Ukraine's capital. It comes as the EU consults member states on its next sanctions package, the bloc's 18th since Russia's full-scale invasion of Ukraine over 3 years ago. Let's bring in Tom Keating, founding director of the Centre for Finance and Security at the Royal United Services Institute, RUSI. Tom, great to catch up. Thanks for joining us. 18th package, that's what we're dealing with out of Europe. We were just talking about the kind of kinetic side of how Europe is dealing and trying to persuade Russia to withdraw. Let's talk about how the financial side of that equation is playing out. We've got the 18th round of sanctions being talked about right now. How effective have the previous 17 rounds been in deterring Russia from taking action in Ukraine, do you think?
Well, the short version is the war continues, and therefore you could argue the sanctions have not been effective, but they have degraded the Russian ability to pursue its war through two lines: reduce funding, so go back 3 years, the foreign exchange reserves of the Central Bank of Russia were frozen, mainly in Belgium, and then access to the technology that Russia needs is being restricted. But it's all happening too slowly. Promise of massive sanctions are repeatedly made by European leaders, and yet we are moving at a glacial pace, sadly, for the Ukrainians.
Does that mean ultimately that the Russians can outpace any sanctions that are applied? And if so, what would be effective at this point?
It's a mindset difference. So for the Kremlin, outpacing sanctions is existential. If Russia does not outpace sanctions, then its economy will collapse and its war will fail. In Europe, we continue to think that we can issue sanctions that will hurt Russia without hurting ourselves. And this is obviously a political challenge for leadership in Europe. If we really wanted to crush the Russian economy, crush its ability to fund its war in Ukraine, then we would have targeted energy sources, LNG, oil, and so on, much, much harder a long time ago. And that's why it's interesting to see what people like Lindsey Graham are talking about in the United States. There's a willingness in the US, it sounds, to go after oil sales in a way that at the moment in Europe we're just not prepared to do.
Yes, I mean, so with that in mind, Tom, how do you evaluate the G7's failure to agree on bringing down that price cap on Russian oil, seaborne oil, the price at which it must not go above if it's to be insured and transported by Western infrastructure?
Well, the oil price cap was a great idea, saying to countries like India and China 3 years ago, you are welcome to buy Russian oil as long as you buy it at a below market price. What's not to like about that? But frankly, the development of the so-called shadow fleet, the ability of Russia to continue to sell its oil around the world to willing buyers has made a mockery of the oil price cap. And so that's why I think ideas such as the one put forward by Lindsey Graham to say, if you choose to buy Russian oil, then we will punish you, China, India, and others. We have to go after the supply side. We see from the way in which the Russians react when the oil price drops, for example, how painful that is for them. So if we can stop them from being able to sell their oil, curtail the shadow fleet, then we might be onto something. But at the moment, sadly, we're just nibbling at the edges in Europe. We need to be much harder and go much faster.
Yes, I mean, I suppose some people might push back and talk about sovereignty and independent nations being able to decide for themselves. China maybe and India decide for themselves whether they want to take Russian oil, and it might seem a little extraterritorial if the US Republican plan were to be enacted and put 500% tariffs on countries that do buy Russian energy. I suppose it could be done, though, just to force people to the table. Would that be the aim, Tom?
Look, I think fundamentally, you start using the word extraterritorial, the people acting extraterritorially are the Russians by invading Ukraine. I think everybody would want this war to end. At the very least, it's a distraction in international relations. And of course, it's a tragedy for the Ukrainian people. There are other sources of oil. You don't need to buy Russian oil if you're China or India. And they're choosing to prolong the war in Ukraine by funding the Russian government. So we haven't seen any sanctions from the United States on Russia since Donald Trump took over the presidency in January. And now, if he really is, quote unquote, pissed off, very angry, etc., with Vladimir Putin, would be the time to follow the lead of the likes of Lindsey Graham. And it's also the time for the Europeans to step forward with the, again, quote unquote, massive sanctions that they've repeatedly promised but not delivered.
Tom, as Kriti in London, prior to Donald Trump's most latest comments, as you put them, on Vladimir Putin and simply being annoyed by that, he's previously talked about recreating a trade relationship with Russia. It doesn't really seem on the table at the moment, but he has made that comment in the past, which at the time begged the question of what a rehabilitation of Russia in the global economy actually looks like. Tom, from your perspective, is that still a possibility?
Well, it's a real worry for Europeans. We know that Vladimir Putin loves to drive wedges between allies, whether it's between European Union member states or whether it's a transatlantic wedge. And of course, if the Kremlin were to play its cards in a certain way, it would offer trade opportunities to Donald Trump. Nobody likes a deal more than Donald Trump. And that would be a classic way of the Kremlin driving a wedge across the Atlantic. So imagine, for example, Boeing being given lots of interesting deals by Russia, but Airbus continuing to be frozen out. That's a nightmare scenario for the Europeans. So I'm not surprised to hear talk of deals. I'm sure on these long phone calls that Donald Trump has with Vladimir Putin, Putin dangles deals like that for him. So this isn't over. And the Trump administration has yet to put sanctions on Russia. So until we see that happening, we have to assume that Trump is more interested in rapprochement with the Kremlin than he is in ending the war in Ukraine using tough sanctions on Russia.
Well, Tom, you talk about those kind of carrots that may be used in terms of enticing Donald Trump. Talk to us a little bit about the energy space as well, because you specifically said that the EU has been hesitant to acknowledge and really address that part of the sanctions market. What would it take to get there?
Well, let's talk about Russian oil primarily. I mean, at the end of the day, the Europeans control more or less the export of Russian oil because it passes through the Baltic Sea, it passes through the Danish Straits, it passes through the English Channel, it passes through the Straits of Gibraltar. Those are all stretches of water that Europeans control. But of course, international maritime law and the rights of innocent passage mean that it's very difficult to disrupt those tankers. What we have started to see in the Baltic Sea is countries like Estonia being creative with the way in which they try and interdict vessels that they suspect are carrying Russian oil at a price above the price cap. So fundamentally, we need to see more of what the UK has done actually over the last 2 or 3 weeks, which is sanctioning vessels that are operating in breach of the oil price cap. We need to see sanctions on infrastructure. So that means the brokers that are selling these tankers to the shadow fleet, the Chinese refineries that are refining, and really, as I say, go full court press on the oil side, because without that revenue, the Kremlin is lost. And we can see just from daily reporting how the cost of groceries and the ability of general Russians to kind of lead their lives is being impacted by this. But we haven't been willing to press our foot to the floor. And that's what we need to do now if we want to end this.
Tom, Europe has been through an energy crisis over the last few years. Would what you suggest cause a similar outcome? What would it do to European industry, and what would it do to European consumers? Because politicians are short-term thinkers, and they worry about these kinds of things. And so I'm wondering what the net effect of this will be in Europe. The resistance to doing this seems obvious because of those sorts of concerns. Am I barking up the right tree when I think about it along those sort of lines? Because that's a really big story to overcome.
Yeah, no, look, you're absolutely right. And indeed, in some countries like Hungary and Slovakia, in a way, that argument has already been won. That's why the Hungarians and Slovakians are so negative and push back on EU sanctions. I mean, if I had a euro for every time I've heard an official in the German foreign ministry, for example, say, Tom, you've got to understand, we have Mittelstand companies that have long-standing relationships with Russian companies. It'd be very difficult to tell them to stop trading with Russia. You know, ultimately, it's a political choice. It's a political choice. And the only way in which Europe is going to really demonstrate resolve when it comes to sanctions is to be willing to take a bit of pain. And over the last 3.5 years, we haven't been willing to take that pain to the extent that is necessary. And as I said earlier, for the Kremlin, avoiding sanctions is existential. And in a way, we need to treat it with the same urgency and vigor in Europe if we want the sanctions to work. If we simply want to drag this out for years and years and years, then carry on doing sanctions the way we are.
Yep. I remember taking a undergraduate course a long time ago talking about sanctions being for domestic purposes rather than actually to achieve anything when it comes to the stated purpose. But that was a long time ago. Maybe things have changed. Tom Keating, Director of the Centre for Finance and Security at RUSI. Thank you very much indeed. Coming up, the EU agrees to accelerate trade negotiations with Washington to avoid a transatlantic trade war. We will have the details of that story next and the reality of it as well. This is Bloomberg.
Welcome back to the opening trade. About 47 minutes into today's session, seeing green on the screen across the board. Actually, a real rebound. People are buying 47 minutes into the session. We did not see this kind of action at the open. Higher by 0.5% on the stock 600. But again, the outperformer is going to be right here in the UK, the FTSE 100. Really a catch-up trade, higher by about 1%, but you are seeing some optimism over in the States as well. At the same time, the bond market on both sides of the Atlantic catches a bid. In the meantime, as we digest all of this market pricing, let me bring you some headlines in the banking sector. UniCredit, some headlines crossing there when it comes to that banking consolidation story out of Italy. I'm going to a couple of different pieces, so roll with me on this one. Andrea Orcel, the CEO over at UniCredit, rules out any move when it comes to Generali, the major Italian insurer. They do have a stake in that, but they're not looking to increase that into a takeover offer. So that piece is key. The other piece of this is that he's also saying that if the BPM deal does not get approved by the courts in time, it could lapse altogether. And that's the takeover bid that everyone's watching in terms of UniCredit and the share prices there. Nevertheless, you are seeing Banco BPM shares higher by 0.4%. UniCredit shares higher as well. So it doesn't feel like these latest comments are making a dent, but anything can happen in Italy.
Right, and we'll continue to watch the broader European banking sector with deadlines approaching there around M&A. Now, the EU says it will accelerate negotiations with the United States to avoid a transatlantic trade war, days after President Donald Trump criticised the bloc for taking advantage of the US and slow-walking talks. That's his view, of course. I'm joined now by Bloomberg's Oliver Crook in Berlin. Ollie, good morning again. So talk us through the European response here. We heard Ursula von der Leyen had a conversation with President Trump over the weekend, and then yesterday we continued to get this more hurried mood music, I suppose, from the European side.
Yeah, and I think mood music is the right way to characterize it. I don't think there's anything necessarily substantive in terms of what a fast-track deal discussion actually looks like. We don't have any clarity on that, but that is what the EU Commission is now saying. We also had Maro Sefcovic, the sort of top trade official here in the European Union, speaking with Howard Lutnick, the U.S. Commerce Secretary, and Jameson Greer, the U.S. Trade Representative, yesterday. So those conversations were ongoing. But again, what is lacking here is any kind of substance, architecture, framework for us to dig our teeth into and to really get an idea of where the sticking points are. It seems what's been going on is the EU has been going to the United States, trying to read the crystal ball to understand precisely what it is exactly they want, coming up with proposals that seem to be too abstract for the Trump administration's liking, and then basically being shunned and pushed away, and then ending with Donald Trump saying that there's going to actually be 50% tariffs on the EU if they fail to reach that deal by July the 9th, which is now the deadline. And that was going to initially be 20% tariff. That now means 50% tariffs, and that is the thing that everybody is staring down. And of course, for the Europeans, this is a much greater risk than for the United States. That being said, according to Bloomberg Economics, this will still cost the United States about half a percentage point of growth if you do get 50% tariffs on July the 9th.
Let's talk about what else is going on, Ollie, because it's interesting. There's a sort of twin-track strategy being applied by the Europeans. They're talking to the United States, trying to figure out what the relationship could look like there. But they're also talking to the Chinese as well. And we've got talks coming up in a few weeks' time. And I'm wondering whether we need to kind of compare and contrast what is happening with the view west and the view east.
I think absolutely. I think that, for the time being, there is very limited appetite, and we should say this, within the European Union overall for many of the member states to really say, listen, we're going to give up on the United States, we're going to move towards China and have a more open relationship in terms of trade and other things with the Chinese. You have heard some explicit calls for that, specifically from the Spanish, but that has not really gained full traction across the EU. But what we are getting is that top-level trade discussion on the sidelines of that summit in Paris. This will happen in June between Maro Sefcovic and the Chinese Commerce Secretary. But also, Guy, the other thing to look forward to is from the EU leaders. There's going to be a big EU leader trip to Beijing in July, where a number of the leaders across Europe are going to go to China. That'll coincide just about with that July 9th tariff deadline with the United States. If things are not able to move forward with the United States, there's going to have to be a conversation about what this posture is towards China. Maybe China will be willing to address some of the industrial concerns that the Europeans have flagged before. Maybe consumer sentiment will shift. I mean, if you look at the auto market today, there certainly has been a move away from Tesla, the United States, and towards BYD, which has just overtaken Tesla for the first time here in April. Maybe that is not where we should be getting all of our geopolitical and trade cues, but it's something that's certainly present in the conversation.
Ollie, great stuff. Thank you very much indeed for the update. Bloomberg's Ollie Crook joining us out of Berlin. Let's carry on looking at this from various different angles. Blowback from the Trump administration policy certainly putting pressure on global investment flows, with so-called revenge taxes and fund managers in Europe maybe taking a different view of how assets should be managed. Let's talk about all of this. Charlie joins us around the table to figure it all out. There's various kind of buckets of this story, one of which is this revenge tax in the United States, which is aimed at digital taxes, etc., being applied in Europe. And the concern here is that basically the US will up a withholding tax to compensate. Talk us through this story, because this could limit passive funds being held by foreigners in the United States.
That's right, guys. So the Trump administration, it cannot stand digital services taxes. So these are the sort of levies that we see in places like the UK and France and Italy. And basically, they are taxes on revenue generated from users in those countries. And the Republicans don't like this. The tech firms from the US do not like this. And this has been a real sticking point in a lot of these trade negotiations we've been seeing. We've heard Bessent talk about these digital services taxes. And so this is how we're seeing Republicans take them on. And what they are basically saying is, if you are an investor from one of these countries that has the likes of a digital services tax, you are going to see the passive income from your investments in the United States. You're going to see that tax obligation go up. So this is a way to ratchet up pressure on these investors. If you are an investor in the U.S. from one of these countries, you're not going to be happy about this.
How possible is it that this actually comes to fruition? Because at the moment, this is an idea of an idea.
Yeah, this is an idea of an idea, and it is in the bill that was just passed in the House. It is Section 899. We know that this is now going to have to go to the Senate, and there is so much wrangling, so much negotiation that is going to happen between those points. But this has been a talking point between a number of the countries. We've heard it come up with the UK, talking to the US, for instance. And there's a world where investors put pressure on this because they do not like what they're hearing. They do not want to see their tax obligations go up on the back of this.
So that's one story that could dictate flows across the Atlantic to some degree. Another one that we're focusing on increasingly is the attitude of pension funds with big pots to invest and where they put them and the criteria attached. So we've got some really interesting reporting around European pension funds and what they make of money managers in the US and their willingness to stand up to Trump or not.
Again, if you are a U.S. asset manager, this is another risk that you've got to think about. So you're thinking about the Trump administration. You're thinking about how kind of ESG policies are out of favor on that side of the Atlantic. Come to this side of the Atlantic, and you've got warnings from the likes of PME. They're one of the largest pension funds in the Netherlands, and they're basically saying, hey, U.S. asset managers, we do not like how you are not standing up to the Trump administration. We do not like how you are kind of shirking on a lot of this ESG requirements. We do not like what you're doing vis-a-vis the Trump administration and the judiciary. So this is another risk that the like of, say, State Street and BlackRock face, and some of these firms are already losing mandates in Europe. So this is a real risk that they're facing. And basically, PME saying that they're going to use a new framework. They're rolling out a new framework for kind of evaluating these asset managers. And again, if they don't like what they're hearing, they could end these mandates.
All right. Charlie Wells walking us through, as I think I deemed earlier, the pots of money that could move. We thank you so much for walking us through this all the crucial stories. Charlie Wells driving us to it. Let's talk about these markets here because we've seen a real game changer in terms of how these markets are faring. I'm looking at futures over in the States, higher by 1.5%. A lot of that seems to be not just the catch-up trade in the FTSE 100, but you are seeing some optimism in some of the other European sectors that we're keeping an eye on as well, Guy.
Not much of a move at the front end, which is surprising given actually the French CPI data that we saw. So we've got front-end yields down a little bit. The move is really at the back end. So you've got a curve flattening trade that's being put on this morning in the bond market. But the CPI data doesn't seem to have generated a big response at this stage, which in some ways you can argue is a surprise. It's a decent miss to the downside.
Yeah, it's a decent miss to the downside. 0.7% year on year is
well below 2%.
Well below 2% and so far away from where we've been when it comes to European inflation. I mean, how much more quickly do we get to conversations about European rate cuts? That certainly will be something we think about as we watch for other European data points to drop into place around inflation. Don't miss our exclusive conversation with Thomas Barkin, of course, of the Richmond Fed, 2:30 p.m. UK time. This is Bloomberg.